Thank you very much for speaking to us today, Matthew Dobbs from Schroders. I know you've just been talking to delegates about your views for Asia ex-Japan. I mean, one of the first things you were talking about was, you know, it's quite fashionable at the moment for people to be quite rude about growth, and especially in that region. I mean, what's your take on growth over in Asia, and I suppose especially in China? Are you as concerned as some of the headlines would suggest? Or?
Yeah, I mean, the first thing I suppose to say slightly on this growth debate is I am sort of instinctively quite contrarian. And when more and more people speak about how growth is not important for stock market returns, I react against it. So you've got to take some of it is simply a sort of a wish to be argumentative about life. Though actually I do think it can really help if you're operating a business in a growth environment rather than a contracting environment. Now obviously there's a lot of debate over growth in Asia and a lot of debate over growth in China. I mean, to be honest, we don't tend to spend a lot of time obsessing over whether the next Chinese growth number is going to be, you know, 7% or 8% or 11% or 6%. But what we would be concerned and are concerned about is that the composition of growth in China is very fixed asset investment dominated. Consumption has been falling consistently as a percent of the total economy. It's not that consumption isn't growing, it's just that the rest is growing even faster. And you know, when a lot of that fixed asset investment is, just to be honest, quite policy driven, and to be fair, the Chinese policymakers have done a pretty good job thus far, but given the sheer amount that's been spent over the last 3 or 4 years since the global financial crisis, it's very difficult to wean an economy off that credit creation. And so we think there is a risk of people being disappointed by growth in China. We definitely think there are some companies in some areas who have been very reliant on that sort of growth and are therefore at risk in terms of earnings, in terms of outlook. But to be honest, for us, we feel over the next 5-10 years, if China was growing at more like 5 or 6%, given the demographics, that is absolutely fine, and it's still a lot of growth. And there are plenty of other companies who can benefit in that environment if the growth composition shifts a bit.
I mean, you did mention some concerns about China, and I suppose sectors like banking. You mentioned some of obviously the debt levels there. I mean, can you just say a bit about your position on China, as, I suppose, as a percentage of your portfolio, and how
I mean, we're pretty sort of underweight China. But I still have about 15% of my clients' money in China. I mean, it's not as if it's negligible. We are quite positive on Hong Kong, partly because we think the China option in Hong Kong for participating in the growth is pretty undervalued. Some very good, well-run companies. We have more confidence in the corporate governance and the balance sheets and the transparency there. China is still an important investment for us. People tend to talk a lot about the Chinese banks. I mean, to an extent, the Chinese banking sector is like many other banking sectors in the world. A lot of their credibility relies on the sovereign credibility. And I think the sovereign credibility of China is pretty good. You know, 3 trillion of foreign exchange reserves. Okay, they may have fallen a bit recently, but the fact is they've got a lot of options. So I wouldn't want to make it too much into a sort of simply a Chinese bank. But for me as an investor, when I look at the risk reward, not just of Chinese banks, but other companies, sectors, areas I can invest in, I can see lots of others with superior risk rewards.
Because you said that you were liking this sort of a lot of companies in the manufacturing sector at the moment, and obviously the big sector we've been hearing about recently is the consumer and the big story there. But you said there's actually some areas on the manufacturing side that you'd be interested in as well, and that maybe investors have overlooked that.
Yeah, I mean, if you look at my portfolios, my sort of consumer cyclical weighting is very high relative to the universe. But I very much look at it in 2 parts. One part is the traditional one that, I mean, I talk about it a bit as well. I mean, I think it's a key driver of global growth is definitely the rise of the Asian consumer. So part of it is that. The other part actually is bracketed in under consumer, but is some of the areas like auto manufacturing or more diverse light manufacturing, which is catering for not just Asia, which is growing for them, but also the rest of the world. And that's where the dynamic is interesting for me, because I think valuations are reasonable, and you're seeing this market share dynamic of the bigger boys taking share from the smaller boys.
Yeah, and just finally, you mentioned about valuations and actually earnings estimates probably looking a bit more reasonable now and a bit more realistic. Do you think that's actually better for investors in a way, and that their expectations won't be sort of getting ahead of themselves? This is probably in the right sort of area? Or?
Definitely. And to be honest, Asian a turn in Asian markets is much more determined by anticipation of earnings turning up and monetary conditions, those credit conditions. And actually, I think, as I said in the talk, have been quite tight by Asian standards. But people do tend to say, what's earnings growth going to be this year? And I sort of feel if I say 15%, they're all happy, and if I say 3%, they're all worried. But oddly enough, for me, actually, a low but realistic earnings expectation can actually be quite good news for market returns on the succeeding 12 months, because there's scope to be at least not too badly negatively surprised, and actually there might be some scope for being pleasantly surprised.
Okay, thank you very much, Matthew. Thank you.
Not at all. Thank you for giving time.